Hey everyone, and welcome to The Explainer. Today we're jumping into one of the most important tools in any investor's kit, the bond. So what on earth is it? And is it right for you? Well, let's dive right in and figure it out.
Have you ever felt this way? You want your money to make money, but the crazy ups and downs of the stock market, it's just a little too much like a wild theme park ride. Well, that exact feeling, that need for some stability, is precisely why bonds exist in the first place. So what is a bond, really? At its heart, the easiest way to think about it is this. When you buy a bond, you're basically becoming the bank. You're giving someone a loan. Yep, it's really that simple.
Okay, so for the official definition, a bond is what's called a fixed income security. But don't let the jargon throw you. The core idea is exactly what we just said. You lend your money to some big entity, that could be a government, like the U.S. Treasury or the Nepal Roster Bank, or a huge corporation, and in return, they promise to pay you back.
The whole life of a bond is actually pretty straightforward. So, step one, an issuer, let's say a government, needs cash to build a new airport. Step two, you come along and buy their bond, which is you lending them the money they need. Step three, as a thank you, they pay you regular interest payments, which in the bond world is called a coupon. And finally, step four, when the bond's term is up, at its maturity date, you get your original loan amount back in full.
Let's make this real with some actual numbers, because that always helps. Imagine you buy a $1,000 bond, and it has a 5% coupon rate. What does that mean? It means the issuer is going to pay you 5% of that $1,000. So, $50 every single year until that bond matures. It's a nice, predictable stream of income.
Okay, so we've got a handle on what a bond is. But how does it really stack up against its more famous and maybe more glamorous cousin, the stock? This is the classic comparison in investing, the big showdown. So let's break it down.
So, when you buy a stock, it's pretty simple. You are buying a tiny piece of that company. You become an owner, a shareholder. You're in it with them. Your fortune rises and falls right alongside the company's.
But, and this is the key, when you buy a bond, you are not an owner. You are the lender. You've simply loaned the company your money. This right here is the single most important difference to get, because it changes absolutely everything about risk and reward.
So this whole lender versus owner thing creates this fundamental trade-off, right? As a bondholder, the lender, your returns are typically lower, but they're way more predictable. As a stockholder, the owner, you've got a shot at much bigger returns, but you're also taking on a whole lot more risk. And here's where it gets really serious. If a company goes bankrupt, bondholders are first in line to get their money back. Stockholders, you're at the very back of the line, and honestly, you often get nothing at all.
Which brings us perfectly to the two sides of the bond coin, the promise and the peril. Bonds are built for safety and stability. That's their whole job. But that definitely doesn't mean they're risk-free. They have their own unique set of dangers.
So first, let's talk about the good stuff, the promise. Bonds give you that stable, predictable income from those regular coupon payments. They're generally lower risk and a lot less volatile than stocks. You're also preserving your capital, since you expect to get your full investment back when the bond matures. You put all that together, and it makes bonds a fantastic tool for diversification. They can be that steady anchor in a stormy stock market. All right, now for the other side, the peril. The flip side of lower risk is usually lower returns compared to stocks over the long haul. And bonds have their own special kinds of risk. You've got credit risk. That's the chance the company or government just can't pay you back. Then there's inflation risk, where those fixed payments you get every year buy less and less stuff over time. But the trickiest one of all is interest rate risk.
Let's really focus on this for a second, because it's super important. So imagine you own a bond that pays you 3% interest. But then, all of a sudden, the market rates for new bonds jump up to 5%. Now think about it. Why would anyone in their right mind buy your old 3% bond for full price when they could just go out and get a brand new one that pays 5%? They wouldn't. So to make your bond attractive to a buyer, its market price has to go down. It's like a seesaw. When interest rates in the market go up, the price of your existing bond goes down.
So, after all that, with all this in mind, we get to the big question. Is a bond a good fit for your personal investment strategy?
Well, bonds are often a fantastic fit for more conservative investors who are really looking for that steady income more than huge growth. They're also super popular for people who are getting close to retirement and want to protect the money they've worked so hard to save. But really, bonds can be for just about anyone who wants to diversify and add a safer, stabilizing force to their portfolio.
And if this is sounding pretty good to you, getting started is actually quite simple. You can often buy government bonds straight from the source. You can also, of course, just go through your bank or a brokerage firm. Or a really popular option is to invest in bond ETFs or mutual funds. They're great because they hold a whole bunch of different bonds all in one package, so you get instant diversification.
So what is the one big thing you should take away from all of this? It really all boils down to this single powerful idea. Bonds are fundamentally safer than stocks. They give you that steady income, and they are designed to protect your initial investment. The trade-off, and there's always a trade-off, is that their potential for those really high returns is almost always going to be lower.
And that leaves us with one final and really crucial question to think about. We know bonds offer stability. It's what they do. But in a world where the cost of everything is going up because of inflation, you have to ask yourself, is the stability from a bond's fixed payment really enough? That's a question every single investor has to answer for themselves. Thanks for joining us on The Explainer.